Hi, y'all. I'm John Rotonti, a portfolio manager at Bastion Fiduciary and one of the hosts of Rebellious Allocations, which is our Bastion Fiduciary podcast. The date is December 4th, 2025. Today, I'm joined by Nick Lieb for a business deep dive into Vertiv, ticker VRT. Vertiv is a stock that I own in the industrials and infrastructure portfolio that I manage at Bastion Fiduciary. Nick is an equity analyst covering industrials at Morningstar, and there's a lot of overlap between his coverage universe and the high quality universe I focus on at Bastion. Nick, welcome to the show.
Thanks so much for having me, John. I've followed your investing research since you were at the Motley Fool. So it's awesome to be able to talk stocks with you.
Wow, Nick, thank you. I really appreciate you saying that. So before we jump into the questions, I want to give some very high level company statistics so listeners get a gauge for the size and scale of Vertiv's business. Vertiv has a market cap of about 68.3 billion and net debt of about 1.3 billion. So its enterprise value is right around 70 billion. In the trailing 12 months, Vertiv generated revenue of about 9.7 billion and net income of slightly over 1 billion. So that's a net income margin of nearly 11%. And then, as far as cash flow, over the last 12 months, Vertiv generated operating cash flow of 1.56 billion. And then if we subtract CapEx of 187 million and also subtract acquisition spend of 239 million, Vertiv's free cash flow, even after subtracting acquisitions, was over 1.1 billion. So over the last 12 months, Vertiv generated a free cash flow margin of nearly 12% and free cash flow conversion on GAAP net income of over 100%. So on to the questions now. Nick, can you give us a brief history of Vertiv? When was it founded? Why was it founded? What problem was it trying to solve at the time? And then please just briefly take us through any key inflection points in the company's history.
Yeah, absolutely. So Vertiv has quite the rich history that dates back to the mid 1900s. It has a flagship brand called Liebert, which was formed in 1965 by none other than Ralph Liebert. Ralph and his team invented the very first precision air conditioning unit designed to cool mainframe computer rooms, which, believe it or not, have existed in some form since the 1940s. These early mainframe computer rooms were gigantic and inefficient, oftentimes taking up thousands of square feet. And so from the very start of their use, these data center precursors generated massive amounts of heat and required cooling capabilities that standard HVAC equipment simply could not meet. Logically, another acronym came into existence to describe Liebert's invention. So these data center HVAC units became known as computer room air conditioners, or CRACs. So fast forward a little bit through the 1960s, 70s, and 80s, Liebert steadily developed pieces of thermal and power management equipment to help solve the problems plaguing the data processing industry. It created an integrated solution combining its original CRACs with products like the uninterruptible power supply, or UPS, which keeps data centers powered when their main power supply is interrupted. The company Liebert went public in 1981, listing on the NASDAQ under the ticker LIEB. And as a side note, I'm not related whatsoever to the company or the Liebert family, but it is quite the uncommon name, I will admit. So the company was acquired by Emerson Electric in 1987, and it was bucketed into what Emerson called its network power business unit, along with some other data center infrastructure brands like Avacent and Nur, which is German, spelled KNURR. And fast forward to 2016, Platinum Equity, a private equity firm, bought the entire network power business unit from Emerson and renamed it Vertiv. And Vertiv then went public in 2020. Platinum has since sold its stake. And so now the company is a standalone public entity.
Okay, awesome. Great little rundown history lane there. So, Vertiv has been providing thermal solutions to big computer rooms since its founding in the 1960s. But let's dive deeper into what does Vertiv do. I think about 80% of its revenue is derived from data centers. So, what products does Vertiv sell into the data center?
So yeah, that is true. Over 80% of its sales are derived from the data center end market. And then the remaining one fifth or so is from products sold into other commercial, industrial, and telecom structures. Um, so I think it would be helpful to give a broad overview of a data center's anatomy to really see where Vertiv competes. So if you will, picture data centers as giant digital brains that power the modern tech stack and host the digital operations of entire enterprises. Within them are servers that store and process data, networking equipment that acts as the communication system with the outside world, thermal equipment that regulates the whole system, power equipment that brings electricity to it, and security and monitoring equipment that washes for internal and external threats. And then there's the physical infrastructure that houses everything. Vertiv primarily competes in the thermal and power management categories, and this is reflective of its flagship brand, Liebert. Essentially, all of Vertiv's thermal equipment sales are Liebert branded, and a good portion of its power equipment sales are too. So, if we dive a little bit into thermal, Vertiv derives roughly a third of its revenue from that category. Makes very highly engineered cooling systems that are comprised of equipment like condensers, chillers, coolant distribution units, and then software that monitors everything. And the name of the game here is to maintain proper temperature, humidity, and pressure so that the very sensitive electronics within the data center can function without damage or disruption. And these thermal management products generally have useful lives of around 15 years, but they can last considerably longer depending on a number of factors. And then another third or so of revenue comes from power management equipment sales. So, primary product categories here we got uninterruptible power supplies, switch gear, busways, power distribution units, quite a few categories here. And Vertiv's job within this category really is to regulate voltage, ensure continuous power to the data center, and allocate that power across server racks and rows. And power equipment generally has a useful life of around 10 years. And then if we move into its smaller businesses, still considerable though, a low teens percentage of sales are from what Vertiv calls its integrated rack solutions, which basically consists of containment structures for servers like racks, cabinets, and closets. A smaller portion of this business consists of Vertiv essentially building prefabricated modular data centers where a customer gives Vertiv their specs and Vertiv more or less designs and builds the entire thing. And the last portion of Vertiv's business is its most lucrative. Around one fifth of sales are derived from what Vertiv calls its services and spares business. And I will get into this part of its business in a bit. But what I'll say for now is that data centers can remain in operation for upwards of 20 years. So not only does Vertiv deliver new equipment, it also deploys a team of highly technical engineers to monitor and maintain that equipment.
That was incredible. Can you talk a little bit more about how AI data centers, or what Jensen Huang, the CEO of NVIDIA, calls AI factories, how are they built? What types of different products and equipment are installed inside an AI data center? How much of the AI data center build out cost goes to power and thermal equipment? And why is this AI infrastructure build out? And along with it, increasing server rack densities, how is that driving demand for Vertiv's product suite?
The basic anatomy of an AI focused data center is actually quite similar to what I just laid out for traditional cloud focused data centers. They both have compute, storage, networking, thermal, power, security equipment. And for both data center types, server hardware is far and away the largest capital cost. Every data center is going to give you a different cost breakdown, but from my understanding, server equipment makes up anywhere from 40 to over 70% of the bill of materials. And then thermal and power management equipment ranges anywhere from 10 to 30%. And then going down even further, networking and security, 5 to 20%. And then engineering and construction, around 10%. And just to be clear, data centers are increasingly being built to host both cloud and AI servers for versatility. But AI servers have a few key differences in their anatomy. Most importantly, they deploy GPUs, whereas cloud servers primarily rely on CPUs. And this is basically because GPUs can handle way more complex computational tasks, but that does come at a cost. They draw considerably more power. And on top of that, they are more densely bundled in an AI focused server. So there's essentially this multiplier effect going on. And so as a result, an AI server can draw over 10 times more power than a cloud server, which necessitates higher spec power management equipment. And on top of that, that comes with generating a lot more heat as well. So their cooling infrastructure has to be beefed up. And then at the chip level, liquid cooling has become a primary method of heat removal within an AI server. So even though AI focused data centers necessitate much greater power and cooling capabilities, their dense server racks of very expensive GPUs still dominate the bill of materials. This means that Vertiv's equipment is a relatively small part of the cost pie, but is absolutely mission critical.
So we hit on the product portfolio and how that fits into these AI factories. Can you please talk about Vertiv's services business? What services are they providing? And maybe just a bit more on the growth and margin profile of Vertiv's services business. Like, is it growing slower or faster than their product revenue? And are margins lower or higher?
So, like I mentioned earlier, around 1/5 of Vertiv's revenue stems from its service business. The company has a team of over 4,500 field engineers that are stationed around the world, and they have decades of experience working intimately with data center customers. Their presence at the pre build stage to make design recommendations, help optimize the data center layout, and then to maintain the equipment for the multiple decades that a data center is in operation. And this gives rise to a long tail of higher margin aftermarket sales in the form of replacement parts, upgrades, and then services like remote monitoring, calibrations, cleanings, and testing. These types of services are absolutely paramount because equipment failures and downtime are not really an option for data centers. Vertiv has a reputation in the industry for its quick and consistent support, which is highly valuable to data center operators who likely don't know the equipment as well. This service business is growing slower than Vertiv's new equipment sales, just given how crazy capital equipment demand has been during this current data center build out. But that being said, the service business is still growing in the low teens, and it garners a 400 basis point gross margin premium. So we estimate that Vertiv's new equipment sales have around a 36% gross margin, meaning services and spares are sitting around that 40% level.
Wow. Yeah. Nick, you rate Vertiv as having a narrow moat. In your opinion, what are the sources of its moat?
In a nutshell, Vertiv wins a sale with its intangible assets and then generates repeat aftermarket sales because its equipment has high switching costs. So that first moat source, intangible assets, From my understanding, data center and other commercial customers decide to buy new equipment based on three main factors, which are superior performance specs, brand strength, and a full service offering. That first one, performance specs, it encompasses things like equipment efficiency, durability, efficacy. So this is really important because energy and maintenance expenses dominate the total cost of ownership for Vertiv's equipment the longer it's in operation. So again, think decades of continuous running. The sticker price for a piece of equipment ends up getting dwarfed over time. And a number of Vertiv's products, like its Class 1 UPS, have the highest efficiency in the industry from decades upon decades of incremental improvements. And a great illustration of durability requirements can be found if we look at Vertiv's direct expansion cooling system, which acts essentially as an industrial grade air conditioning system with a lot more moving parts. So if we zoom in on that system, there's numerous giant fans that are designed to operate in temperatures ranging from -40 to 150 degrees Fahrenheit. They have to ramp their speed up and down rapidly and run nonstop. So 24/7, 365 days a year for the entirety of the system's useful life, which can exceed 15 years. And think about if a component in this system fails. If the data center doesn't have backup cooling, a thermal runaway can occur and critical hardware can get damaged. And then we're talking about downtime, the potential for permanent losses on a system that hosts the data of entire enterprises. And so that links pretty directly to the next purchasing factor, which is brand strength. I mentioned Liebert's heritage. It's effectively the original brand in precision data center cooling. And this is a huge source of competitive advantage. A fun anecdote that I've heard from industry participants is that pieces of Liebert's equipment that were installed in the 1970s are still in operation today. And this time tested longevity is extremely valuable because the engineers who select equipment have a very low risk tolerance. They're going to be reaching for what they know will not malfunction. And then the last, but still equally important purchasing factor is the robustness of a company's offering, which is basically comprised of product breadth and customer service. Thermal and power equipment interact in a data center, and Vertiv optimizes those interactions, which greatly boosts the overall system efficiency. And I may mention this a few more times, but data centers are in continuous operation for upwards of 2 decades, very complex to design, and equipment within them needs close monitoring and pretty regular maintenance. And so Vertiv's field engineers can do all of this and more. They become a go-to engineering consultant and a full service partner for data center customers, which leads pretty well into the second mode source, switching costs. Vertiv co-develops its equipment with customers, and its equipment is then specified in the design blueprints of data centers. So once a piece of equipment is installed, replacing it, it requires redesign, testing phases, and then potentially some operational downtime to install it. But it is super risky to swap out equipment once a data center is in operation because electrical systems are highly sensitive to change. And so you can imagine that all of these factors add up to significant implicit and explicit switching costs.
Yeah. And while we're talking about the services business, would you describe any of Vertiv's revenue as recurring in nature?
Yeah, Vertiv has disclosed that around 3/4 of its services and spares business is recurring, with the remainder being one-off projects. This recurring portion is non-discretionary in nature, has to get done, and so it makes it a very steady and highly profitable business. And A nice trend that I've been seeing is that the technical complexity and customization of Vertiv's products are rising over time, which makes it far less likely that a third party can service them.
Yeah, for sure. Do you have any market share estimates for Vertiv? Like, what is its share of thermal and liquid cooling products inside the data center? And what is its share of power products inside the data center?
I don't have concrete numbers, but what I can tell you is that within the data center space, Vertiv very likely holds the number one market share in thermal management, and the number one share in multiple power management categories like switching, distribution units, and three-phase UPSs. That is all to say, traditionally, the commercial HVAC and electrical equipment markets operate in oligopoly structures because they have high technical complexity, capital intensity, and dense service network requirements. And so we suspect that the same is happening within the data center market, where a few players, Vertiv included, hold the bulk of market share.
I am suspecting the same thing. Let's talk about the competitive landscape a bit. So, who are Vertiv's main competitors, and is the competitive landscape shifting at all? Are there any new entrants to speak of? And are the market shares shifting, or are the market shares pretty stable?
In thermal, Vertiv competes directly with some legacy competitors: Johnson Controls, Train Technologies, Daikin, and Legrand. And then in power, Vertiv claims that it holds twice the market share of Eaton and Schneider Electric within the power categories that I mentioned. So switches, PDUs, and UPSs. Point solutions or singular products come to market all the time. However, market shares remain relatively stable because the competitive landscape favors those that have full offerings. So I've talked about this. Vertiv's full product suite, its service capabilities give rise to significant cost savings for the customer in the form of energy reduction, streamlined monitoring, and easier troubleshooting. And there simply aren't that many firms that can compete with the technical prowess, scale, service networks that the handful of top tier players have.
Amazon and Microsoft have both recently announced alternative liquid cooling technologies that they are developing in house. Do you see this as a risk to Vertiv?
The short answer is no. Full blown competition from hyperscalers is possible, but I would say it's unlikely. In order to effectively compete with Vertiv, and Amazon, Microsoft, or Google would not only need to develop a full portfolio of thermal and power equipment, they would need to deploy a team of engineers to maintain that equipment for the decades it's in service. And the problem is that it can take years of being in close collaboration with key players to develop a single piece of equipment. And Vertiv is a leader in the space because it has built upon its base technology for over 60 years. And it has arguably the most robust portfolio of both tailor made and standardized equipment. And then again, yeah, it has that global physical network in place to service the equipment. And that being said, wouldn't necessarily surprise me if hyperscalers develop more point solutions going forward. Amazon's strategy seems to be hybrid, so developing some of its own in-house equipment where it makes sense, and then using third-party vendors elsewhere. Amazon and Google even have their own portfolio of chips that compete with some of NVIDIA's. We've seen a number of those pop up in recent weeks, but even before that, they had some of their own point solutions. And I would just say overall, my view is that the data center pie is sufficiently vast and growing for multiple players to succeed in any given product category.
Yeah, I agree with you. We mentioned some stocks there, so I'll just mention that in the Bastion Industrials and Infrastructure portfolio that I manage, we do own NVIDIA, Amazon, and Alphabet. Do you have any insight into Vertiv's pricing power? Uh, if they're increasing prices, do you know how often they're increasing their prices, and do you know by how much?
Management has hinted at it a few times, and there are a number of proof points that I would say indicate strong pricing power. The main dynamic here is that Vertiv bases its product innovations on alleviating customer pain points. And one of the most chronic pain points involves what is known as the power usage effectiveness ratio, or PUE, which was a metric introduced in 2006. And it compares a data center's total energy use to the energy used by its IT equipment. It's a good proxy for energy being used by thermal and power equipment. And so I'll bring up Vertiv's uninterruptible power supplies as an example again. So from 1970 to today, their UPS energy efficiency, so that is the percentage of energy that is actually used without being lost as heat, has gone from 80% to over 99%. And this has really helped propel the PUE ratio down towards 1 over the last few decades. And this is huge for data center operators because incremental energy cost savings alone can exceed the sticker price of equipment. And so, from my understanding, Vertiv typically charges a premium for its products because of its innovations, its bespoke product differentiation, and an expanding service offering. So management has mapped out Vertiv's operating margin expansion goal, which does include a 1% lift from pricing over inflation. And when you consider its rising value proposition, I think pricing over cost inflation is easily justified.
Yeah. Do you have any estimates for how fast the liquid cooling market is expected to grow over the next 5 years?
Vertiv estimates that the market is going to grow at a 35% compound annual rate, and then air cooling at a 10% rate. These are probably subject to change going forward, given how fast these growth rates are changing. But um, believe it or not, liquid cooling has actually been around since the 1940s. Chip level heat efficiency advanced over the decades, and liquid cooling essentially got shelved in favor of air cooling, which is simpler and requires less maintenance. But like I mentioned, liquid cooling is having this renaissance moment with dense GPU server racks at AI data centers. And that is not to say that air cooling is going to be shelved. It's actually quite the contrary within an AI data center. So, as a small example, legacy cloud server racks can be cooled entirely with air, and those on average draw around 10 kilowatts of power. GPU server racks now draw upwards of 100 kilowatts, and even with liquid cooling installed, there is a residual amount of heat at the rack level. So for a new 100 kilowatt rack, even if 80% is liquid cooled, it still requires 20 kilowatts of air cooling because not all IT components can be liquid cooled. And on top of that, the air still needs to be cycled in data center rooms to regulate heat, pressure, and humidity. So I expect both methods of thermal management to remain quite relevant going forward.
What about the power market that Vertiv sells into? Any idea how fast that market is expected to grow?
We will likely see an uplift given the rising power demands at AI data centers and their accelerating pace of construction over the next few years. And so, for context, the power management market has grown at around a low teens rate in recent years. So, I think mid teens growth assumption is reasonable, if not conservative.
Yeah. What do you think will be the primary drivers of Vertiv's revenue growth and margin expansion over the next 5 years?
So I would say primarily as a stable base of growth. Plenty of enterprises are still in the early stages of migrating their on-premise data to the cloud. The value proposition is very attractive to migrate. You don't have to worry about operating software or security or hardware maintenance, and you get access to all of the services that third parties offer. And older and larger companies can really take decades to fully migrate. So I think this trend has quite the long runway. And then there's AI. So what began as positive optionality for Vertiv's growth has quickly become a significant portion of its business. Although Vertiv does not disclose revenue from products designed for AI focused servers or data centers, I would venture to guess it's in the multiple billions of around $10 billion in total trailing revenue, and an even greater portion of current orders. So we've seen these build outs of critical tech infrastructure before. A good comparison is the .com build out. Generally speaking, companies levered up to build internet infrastructure that many companies with more speculative products utilized. Essentially, capital flooded the market, supply overshot demand, and the sector went through a multi-year digestion period marked by collapsing prices, bankruptcies, and a big consolidation phase. Ultimately, the internet was world changing technology, and a select few companies that supplied its infrastructure and built platforms on it have grown quite profitably for decades. And so I believe that AI will also be world changing technology. I'm not saying that the exact .com dynamic is going to happen with this AI build out. What I am saying, though, is that high growth, nascent markets are a lot more volatile, and difficult to assess than stable, long standing markets with well established spending patterns. So, can this pace of spending go on without hiccups? I'm not sure. And so, Vertiv's revenue growth has become a real point of uncertainty. And then, in terms of margin expansion, Vertiv has three levers, I would say. We've got operating leverage, pricing power, and then some efficiency gains in its procurement, manufacturing, and operations.
Yeah, and that uncertainty that you talk about in regards to its future revenue growth, I think that comes through the stock price. It seems like it's up 3% or down 3% every single day. So
Yep.
yeah, there's a lot of uncertainty there. Talk to us briefly, Nick, about Vertiv's business fundamentals. So in my intro, I briefly discussed some of Vertiv's numbers over the last 12 months, but I'd like to ask you maybe four questions about your estimates for the next 5 years. So over the next 5 years, number one, at what rate do you think Vertiv will grow revenue? Number two, in what direction do you think operating margins will move and by how much? Number three, what level of return on invested capital do you think Vertiv can generate, roughly speaking, over the next 5 years? And then finally, at what CAGR do you think EPS will grow over the next 5 years?
Yeah. So again, this is one of my more difficult companies to assess just because of how wide the range of outcomes for Vertiv's revenue growth is. But yeah, for context, over the last few years, it has accelerated to above 20% top line growth. And this level of growth could go on for a very long period of time, but I am a little bit hesitant to assume that. Before AI data center spending ramped up, Vertiv was growing its top line in the high single digits. So, as a base case for the next 5 years, I model around 15% annualized sales growth, which incorporates high teens, low 20s growth in its data center business, being partially dragged down by lower growth in its non data center business. And with about 50 to 60 basis points of operating margin expansion, got some opportunistic share repurchases going on. This all translates to just over 20% EPS growth. And then in terms of ROIC, even with considerable CapEx requirements, Vertiv has a massive runway for volume growth. So with that margin expansion, relatively stable asset turnover, I think it's reasonable for Vertiv to generate returns on invested capital averaging near 30% over the next 5 years.
I mean, that's a pretty good outlook. 30% returns on invested capital with 15, in your base case, 15% top line growth, and then around 20% earnings per share growth. That's pretty good outlook, in my opinion. How did you decide on the narrow moat rating versus a wide moat for Vertiv? I understand that wide moats are very rare, and according to Morningstar, a wide moat means the analyst thinks the company can maintain returns on invested capital above the weighted average cost of capital for at least 20 years, and that's a really long time. But hypothetically, what would you have to see from Vertiv that would indicate to you it may have a wider moat? Or maybe what qualities or differentiators is it currently missing that maybe prevent it from getting into that wider moat categorization, in your opinion?
So really a few risks give me pause in assigning Vertiv a wide moat rating. Primarily, I would say the over 80% of its revenue currently comes from capital equipment sales and one-off projects. And like we talked about, over 80% of its revenue is sold into data centers. So if an unforeseeable downturn in construction were to occur, Vertiv's business would very likely take a big hit. And then this end market concentration also comes with potential customer concentration because over half of Vertiv's data center revenue stems from what are known as co-locators and the hyperscalers such as Amazon, Google, and Microsoft. And on top of that, Vertiv only has a few years of public history and it has changed hands multiple times. So I'm really unsure how it fared during past large scale data center pullbacks. But with that being said, the rebuttal is that cloud data centers have basically become a modern day utility, and the growth in their demand seems to be a structural multi decade trend. So I think what could sway me to upgrade it is more visibility into its history, proof that it can out earn its cost of capital through an entire business cycle.
Good answer, Nick. Yeah, that covered it. So thanks for sharing that. Moving on, can you please talk about Vertiv's relationship with NVIDIA and NVIDIA's product roadmap and annual cadence, and how important is that relationship to Vertiv's long-term business trajectory and to Vertiv's long-term business fundamentals?
We know that NVIDIA's GPUs currently have an edge in AI training and inference, and Vertiv's equipment interacts directly with NVIDIA's chips. The two have co developed a number of really critical advanced cooling systems and power supplies specifically for NVIDIA's GPUs. And NVIDIA's founder, Jensen Huang, has publicly announced that its collaboration with Vertiv is growing in leaps and bounds. And he also announced that NVIDIA is now aiming to release a flagship GPU once per year with incremental improvements, which is a faster cadence from every 2 to 3 years in the past. And so if Vertiv can remain the preferred partner, then it can essentially snag on to any accelerating volume growth that comes with that. And so I would say the bottom line is that Vertiv discloses that its average customer relationship is over 20 years long. And I think so long as Vertiv and its leading partners like NVIDIA continue to tailor make equipment around one another, Vertiv will remain deeply entrenched in the data center ecosystem.
Yeah, as an owner of Vertiv, two things I loved hearing in that answer was average customer relationship is over 20 years long, and that their collaboration and partnership with NVIDIA is growing by leaps and bounds. So loved to hear that. So we talked about your narrow moat rating. You rate Vertiv's management as standard. So can you please just talk about what stands out to you about Vertiv's management team, which is led by CEO Gio Albertazzi? How do you rate them on operating ability? How do you rate them on capital allocation, corporate culture? And does anything stand out to you, either positive or negative, about Vertiv's corporate governance?
Yeah, a few things stand out. So a number of Vertiv's executives have surprisingly long tenure, dating back to when Vertiv was a part of Emerson Electric. Gio Albertazzi joined in 1998, but has been Vertiv's CEO since 2023. And I think his capital allocation plan has been a significant improvement to their prior one. Vertiv began its public life highly levered. It basically sat around 5 times net debt to EBITDA for its first few years. And prior to Albertazzi's leadership, Vertiv issued quite a considerable amount of shares to fund acquisitions. For example, it acquired E&I Engineering in 2021 for around $1.8 billion. And a third of that, or around 630 million, was actually funded with Vertiv shares, which were trading at 1/7 the price that they are today. Since Albertazzi's promotion, Vertiv has done a number of really good things here. They've ramped up growth capex, made some really strong acquisitions at reasonable prices, and using cash. Authorized a $3 billion share buyback program to repurchase shares during periods of undervaluation, and then also whittled down Vertiv's debt to a much more reasonable load. And so recent acquisitions, Vertiv has really fleshed out its liquid cooling portfolio. Some recent purchases are Coolterra and PurgeRite. PurgeRite was acquired for $1 billion, and again, yeah, made using internally generated cash, which is certainly my preference over debt and equity in most circumstances. So I think if these actions continue, Vertiv's capital allocation rating is due for an upgrade. And then in terms of corporate culture, it seems like Vertiv has a good one. To my knowledge, the Liebert family is actually still involved in some capacity, and certainly instilled a lasting legacy in the company.
Yeah, and on corporate culture, Dave Cote is the former CEO of Honeywell, and he's the chair of Vertiv. Can you please talk a bit about Dave Cote and what role he plays at Vertiv?
Yeah. So he was, in fact, Honeywell's CEO from 2002 to 2017. And Cody was essentially tasked with turning the company around after it merged with Allied Signal in 1999. And he did exactly that. Honeywell's growth, profitability, and returns all inflected upwards during his tenure. That was basically from a number of operational and capital allocation improvements. Now, as Vertiv's chairman, he isn't responsible for day to day operations, but he instead acts as a rich source of strategic advice. He has helped the company with leadership transitions, and I do believe that he has contributed to Vertiv's current positive decision making trend.
What's Vertiv's value proposition? What value are they really providing to their clients?
I think you can link Vertiv's value proposition pretty directly to its economic moat sources. Its tailor made products are backed by a reputation for quality. They each work together to streamline monitoring and save on energy. And the company is essentially a lifelong partner for both data center suppliers and operators. So that's all the way from the design phase to end of life. And so I would say these factors in aggregate make a very attractive value proposition.
Yeah, agreed. Are there any other risks investors should be aware of?
I would just mention that Vertiv's invested capital base started as a bit of a mess because the company changed hands between public and private entities a handful of times. I'm not saying that this is an explicit risk necessarily, but definitely something to dive deeper into.
Yeah, and I wish we had time to dive deeper into that invested capital makeup today, but I'd like to wrap up by just asking you, is there anything we missed in this conversation, in this discussion? Is there anything else you'd like to add to this dive into Vertiv?
Yeah, I would just say the last thing I'll mention for the listeners who have made it this far is that the change of pace for thermal and power management equipment is slow moving relative to IT and networking equipment. And in my opinion, this lower risk of disruption means that Vertiv is a safer way for investors to get exposure to AI and to data centers.
I really appreciate you sharing that last insight with us. I will say that's an insight I latched onto early on in my research for this portfolio that I'm managing. And so on the day one launch of the Bastion Industrials and Infrastructure portfolio almost a year ago, I included Vertiv, but also companies like Train Technologies and Eaton, at least partly for the same reason, Nick. Very well run, what I consider wider moat companies with what I think are long duration profitable growth runways, that have exposure to AI, often co-designing products from the very early stages of their design, but with maybe less disruption risk that you just highlighted. So
Absolutely.
I do appreciate you sharing that insight. Um, Nick, maybe I'll close with a quote from Dave Cody, who was on CNBC a few weeks back on November 17th. And on that interview, he said, quote, "We've got the panoply of the innards of a data center other than the server. So all the innards of a data center other than the server we make. And we're the only ones that have that panoply of product." End quote. So Nick Lieb, thank you so much for coming on to the show and sharing your knowledge of Vertiv. This was really, really great, and I hope to have you back on again soon.
Yeah, it was my pleasure. I would love to be back on to speak about any of the other companies I covered. So yeah, it's great.
I will definitely take you up on that, Nick. Thank you.
Bastion Fiduciary is a fee-only SEC-registered investment advisor. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions or personalized financial, tax, or legal advice. It does not constitute either explicitly or implicitly any provision of services or products by Bastion. All statements made regarding companies or securities are strictly beliefs and points of view held by Bastion or podcast guests, and are not endorsements or recommendations by Bastion to buy, sell, or hold any securities. Clients of Bastion or the host or guests of the podcast may maintain positions in the securities discussed in this podcast.